Hey everyone, it feels like just yesterday I was talking about the retail crowd getting nervous about private credit, the mom and pop investors trying to pull their money out of funds that were never really built for quick withdrawals. It was a stressful time for a lot of folks, including myself back in my early investing days, trying to chase those high returns without really understanding the underlying mechanics. I learned the hard way that when something sounds too good to be true, it usually is. I've been there thinking I could outsmart the market, jumping into anything that promised a quick buck. Spoiler alert, it didn't end well for my bank account, but here's where the story takes a turn, and it is a pretty big one. We are now seeing something different, something that really makes you pause and think. It is not just the retail investors anymore. A recent story confirms that a single large investor, a Swiss pension fund, no less, pushed a private credit fund way over its redemption limits. Think about that for a moment. This was not thousands of individual investors panicking. This was one massive institutional player saying, you know what, I want my money back. That really matters. Because pension funds are not emotional investors. They have entire teams dedicated to due diligence. They understand liquidity, lockups, and the broader credit cycle when they want out. It is a big deal, and everyone should be paying attention. This feels a lot like when I finally realized that my hot tips and can't miss opportunities were just avenues for me to lose my hard-earned cash. It took a big hit for me to wake up and understand that blind speculation is a fast track to financial pain, and now these big institutions who are supposed to be the smart money are starting to show similar signs of unease. So, if the first phase of stress in private credit was retail investors realizing that these investments were not as liquid as they were advertised, this next phase is institutions looking at the same market and coming to a similar conclusion. Even if for slightly different reasons they want out too, this is not some small isolated issue. This is a sign that the underlying assumptions are being challenged at a much higher level. It is a stark reminder that even the most sophisticated investors can face similar challenges when market conditions shift. And if that were not enough, there is another major development unfolding right now. Financial firms are increasingly shying away from loans to software companies, to the point where some asset managers are openly marketing debt securities with a key selling point: less software exposure. Let that sink in. Less software exposure is now a selling point. That is how an asset class starts to move toward what we might call toxic waste status. It does not happen overnight. It does not happen all at once, but it happens one avoidance strategy at a time. It is like when I started avoiding certain investment groups after getting burned a few times, you learn to recognize the red flags. Today, we are going to dive deeper into this escalation in private credit. We have got confirmation of a Swiss institution, a pension fund, forcing a private credit fund right to its limit with just one single loan withdrawal request. And then we have to ask a really uncomfortable question: is software becoming the new subprime mortgages? Now, I know there are huge differences. It is not an exact parallel, but in the grand scheme of how crises unfold, how bubbles turn to bust, and how behavioral changes lead to asset classes becoming toxic, the comparison is worth exploring. And unfortunately, we are seeing some initial evidence that this is increasingly the case, and it ties directly into what we just discussed with those Swiss pension funds and other institutions pulling out. Think about how a Swiss pension fund is now entangled in this potential bust, showing once again the global nature of private credit and how far-reaching the consequences could be. Back in my reckless days, I never considered the global implications of my decisions. I was just focused on that immediate, shiny return. Now I understand that everything is interconnected. According to Bloomberg, a large redemption request from a Swiss pension fund helped force a Vista private credit fund to limit withdrawals. This detail is critical because when people hear redemptions or withdrawals, they often imagine a wave of retail investors. In fact, they are often led to imagine a wave of retail investors. We have all seen the headlines about financial advisors getting panicky calls and wealth management clients getting nervous, a broad rush for the exit from the little guys across the spectrum. And yes, that has been part of the story, though, a much smaller one. Non-traded private credit funds have been dealing with rising withdrawal requests for months. Many have redemption caps, often around 5% per quarter, and a lot of them have had to enforce those limits. This is something I have seen time and again, where the small print, the terms and conditions, really start to bite when things get tough. I used to skim those, thinking they did not apply to me or that I would be smart enough to get out before they mattered. Another costly lesson learned, but the Vista situation adds a different, more concerning wrinkle here, is a quote from Bloomberg that really captures it. The withdrawal request from a single institution rather than legions of retail investors paints a very different picture than the redemption pressure that has engulfed the $1.8 trillion private credit market in recent months, as concerns mounted over loans to software companies threatened by artificial intelligence. Now, that is a very narrow concern, and it has already broadened much more than that, but it is a good starting point. At this point, the single institution versus legions of retail investors is key. This is where the narrative really starts to shift, or at least it should have already shifted, because this is just more confirmation. Private credit defenders have tried to frame the redemption issue as primarily a retail product problem. Their argument is basically that private credit itself is fine, but some semi-liquid funds were sold to investors who did not fully understand the liquidity mechanics and the liquidity terms, and there is some truth truth to all of that. Of course, that is exactly what happened to me when I was dabbling in things I did not fully grasp. But if institutions are also pulling their money out, and we are seeing that in more and more places, that explanation just does not hold the same amount of water. A pension fund is not supposed to be emotional tourist money. A pension fund is supposed to be long-term capital. It has consultants, it has due diligence processes, it understands lockups, gates, liquidity limits, and the bigger picture of the credit cycle. So, when a pension fund wants out, the market really should pay attention. Everyone should pay attention, especially as we are starting to see many more examples to the point where the vast majority of withdrawals are coming from institutions. This reminds me of when I used to rationalize my own bad investment decisions. I would blame external factors or the complexity of the market rather than admitting I just did not do my homework. It is easy to point fingers, but the truth is usually a lot simpler and more uncomfortable. Now, I almost never do ads, and I say no to the vast majority of those that are brought to my attention, but I was thrilled to be able to work with today's video sponsor, Monetary Metals. And the reason is because they are solving a big problem, one that I have been highlighting for a very long period of time. Gold is a safe haven, but other than sitting in a vault, it does not really do anything. Monetary Metals fixes that. They let you earn real yield paid in physical gold without giving up ownership. It is not a fund, it is not a paper claim, it is your gold working for you. Every month, more gold gets deposited into your account. It is simple, it is transparent, and it is fully insured if you believe in gold as a long-term store of value. As I do, this changes everything. Go to monetarymetals.com/NDR. That is monetarymetals.com/NDR for all the details. We absolutely thank them for being the sponsor of today's video. And now, let us get back to it. In this case, an institution over there in Switzerland is once again demonstrating, if not emphasizing this point, the private credit bust is global. Therefore, the consequences are going to be far-ranging, reaching all over the rest of the world. I know some people might say, so what? It is just one Swiss pension fund. What does that really matter? But that is actually the point. If one large investor is big enough to force a fund to limit withdrawals for everyone else, it tells us something really important about the overall structure of these things. These vehicles are often marketed with some form of periodic liquidity. Investors can redeem shares subject to limits, but the underlying assets are private loans. They do not trade every day. They do not have deep, transparent markets. And in stress conditions, they may only be saleable at a discount if they can be sold at all. So a fund can look perfectly liquid when money is flowing in, but when money starts flowing out, the structure gets seriously tested. If new money is coming in, redemptions are easy, investor A wants out, investor B comes in, the fund uses new subscriptions to satisfy those withdrawals, but when inflows slow and redemptions rise, the fund has to find cash somewhere else. It can use its reserves, but it can also slow new lending, it can borrow, but that is becoming increasingly difficult. Usually it has to sell assets, as well as limit those redemptions. And once those redemptions get limited, the psychological problem only begins. We pointed this out way back in the fall of last year with the UBS funds. Remember those? That is what got all of this started. And here we are again, because now investors know for certain that liquidity exists only on paper, if it exists at all. And that has created a feedback loop. Once investors believe a fund might limit withdrawals, and we have seen way too many examples of that already, they might start submitting redemption requests even if they would not have otherwise. It is a scramble to just get out, to get the hell out. It is not quite a classic bank run, but it is very similar in its psychology. And in private credit, the danger is not necessarily one giant overnight collapse. The danger is a slow, motion liquidity squeeze, where gates and queues and asset sales gradually expose the gap between reported values and market values, where price discovery starts discovering uncomfortable pricing, exactly what we are seeing all over the market and with increasing frequency. This is stage 2 behavior, and it is getting even more entrenched. Now, let us connect this back to software, because as I said, we really have to start thinking about the software sector as maybe the private credit equivalent of subprime mortgages. Now, subprime mortgages were not the sole cause of the 2008 crisis, but in many ways they were the spark that lit the fuse. And we are getting the sense that the same thing is happening here with software. They are the spark that is leading down the road toward toxic waste status. For years, software companies were treated as premium borrowers in private markets. The pitch was simple: recurring revenue, subscription contracts, high gross margins, strong customer retention, and scalable business models. Private equity firms, they bought software companies at higher and higher valuations. Private credit lenders financed those deals. Everybody liked the story because the companies looked stable, asset, light, and predictable. It was the can't-lose narrative of its time. And I fell for plenty of those myself. But there was a problem. A lot of these businesses were priced and financed for a world that just did not exist. A world where growth would continue unchallenged forever, where valuations would stay high, where refinancing would remain available, and software margins would remain protected. Then, the recovery really failed to take off, Growth slowed at best. It forgot how to grow. And now artificial intelligence is raising a much bigger question. What if some of these software companies are not quite as durable as investors had assumed? AI threatens parts of the software market in two different ways. First, it can reduce the value of existing products by making it easier and cheaper to build alternatives. And second, it can pressure pricing. If customers believe that AI tools can replace expensive software subscriptions, then revenue that once looked recurring may not be as sticky as advertised. And that matters enormously for those who lent the money for private credit, because lenders underwrote many of those loans based on recurring revenue and profit assumptions. And if those assumptions weaken or just disappear, leverage goes up, interest coverage goes down, refinancing gets harder, and the loan that looked perfectly safe at par suddenly looks like a lot less than par. This is why software exposure is now becoming a stigma, and according to Bloomberg, firms including Blackstone and Guggenheim have been involved in new credit products where a key perk, a key selling point to those products is reduced software exposure. That is the market speaking very loudly. When a firm markets a security by saying it has less exposure to a certain sector, it means investors are asking about that sector. Not just asking, they are openly worried about it. They want to know they are not buying a portfolio with what everyone increasingly sees as toxicity. It is like when I started seeing guaranteed returns in bold flashing letters. My gut instinct after getting burned was to run the other way. You learn to read between the lines, to see what is being emphasized, and more importantly, what is being avoided. In 2006, subprime was a yield opportunity. By 2008, subprime was utter toxic waste. Now, that does not mean software loans are the same as subprime mortgages. As I said, they are not identical. The structures are different. The borrowers are different. The financial system is way different than it was back then. But the psychology, that is very familiar. And that is the part to focus on, where the perception of toxic waste sticks first and most obviously an asset class that goes from popular to questioned to avoided and then outright toxic. And software loans appear to be running down the path toward that toxic waste status. And if they get there, that is when you start talking about contagion. First of all, within the private credit space, and then further into stage 3, maybe not just inside of private credit, but spilling over outside too. And this may be the most important signal in the entire story. Not defaults, not downgrades, not a single redemption. The signals that firms are now trying to raise money by saying this portfolio has less of the thing everyone is afraid of. That tells you the market has seriously changed. During the boom, software exposure was a badge of quality. It meant growth in recurring revenue, not to mention probably a private equity sponsorship. It meant the borrower was part of the modern economy. Now, less software is being marketed as a key feature. It really is a dramatic reversal. And reversals like this matter because credit markets are built on confidence. If investors stop wanting this type of exposure, then lenders stop making those loans. And if lenders stop making those loans, borrowers cannot refinance. If borrowers cannot refinance, more loans become distressed. And if more loans become distressed, investors become even more worried. And they see that they have even more reason to be worried. That is the credit cycle. It is a vicious loop. The concern is not just that some software loans will lose money, because of course some of them are going to. The bigger concern is that an entire category of the private credit space and private credit collateral becomes harder to finance, harder to sell, and harder to value. Because once buyers say, I do not want that exposure, price discovery, which gets forced more and more on the system, gets to be uglier and uglier. A loan that was marked at 95 may only clear at 80 or 70, perhaps 65, as we saw the other day, or maybe there is no real bid unless the seller accepts completely distressed pricing.